Good evening, all. Today's topic is about mutual funds. What do you understand exactly by the word mutual funds and what these companies do? Mutual fund is a company that will pool the money from various investors, from different investors, from different customers, and they will take their money and invest in the securities such as stocks, bonds, short-term debts. So whatever the money they have collected from all the investors, they will invest in different areas so that we can transfer the risk and at the same time we get the maximum returns out of it. Diversification of risk. The main advantage of mutual funds is when you collect the money and when the companies invest in different areas, here the risk is transferred from one person to another person. There is a diversification of risk, transfer of risk. At the same time, because it is a hybrid portfolio, it combines of various securities in it, the combination of equities, debts, and all. It gives you maximum returns with the minimum risk. That is the advantage of mutual funds. So the investors buy the shares in the mutual funds, and each share represents the investor's part of ownership in the fund, and it generates the income. So that is a whole idea about the word mutual funds. So why do people buy mutual funds? What is the main important reasons for buying the mutual funds? The first comes is your professional management. The fund managers, they will do, for example, if I want to purchase mutual funds and I have only limited idea about the mutual funds, what I'll do, I will go to an investment firm where they will give me a clarity and the expertise on this particular subject. So I will tell what is my income, how much risk I can take. Okay. So I will tell all about my personal details. So what my fund managers will do? They will create a separate strategy for me based on my income, based on my risk. Okay. Based on my occupation. Um, so based on certain things taken into consideration, they will give me a customized strategy for me. They will do all the research for me. Okay. So according to my risk appetite also, they will choose the securities and they'll put in front of me saying, sir, these are the interest securities for as per your income, as per your risk appetite. So you can choose. Okay. So these fund managers will help you out in searching information on which securities is better for you according to your customized information. Okay. So that you can go for with better investments and with the maximum returns. That is our only intention as an investor. As an investor, I will never want losses to be occurred. Okay, very often. So always I will go for such portfolio strategy where I will get with the minimum risk, I will get maximum returns. So that I can monitor my performance at the same time manage my balances as well. Second, diversification. Very important. It's a saying no that don't put all the eggs in one basket. Should not put all the eggs in one basket. Why? Why? Because if you put all the eggs in one basket, it will break. It will incur loss. The same case goes with the mutual funds also. If you put all the money in one single area, one single sector, for example, if I'm putting all my money in the real estate industry or in real estate sector, what happens if anything happens in the real estate sector or prices coming down? Okay, I have invested in 30 real estate companies. So what happens because of one, in case if any one real estate company has gone into frauds, and then what happened? The impact definitely it will have its impact on other companies as well. So why to take a risk? Put their money in different sectors so that there will be a balance in your portfolio, so that risk can be transferred. Okay, and you'll get maximum benefit out of it. See, as an investor, your aim should be lowering your risk and maximizing your return. Okay, so that is why diversification. Third, affordability. Yes, now mutual funds is quite affordable. I mean, with the limited amount, with the limited amounts, you can purchase a mutual funds. Yes, so SIPs have come, no, systematic investment plans. There are different varieties of plans which are available in the market according to your comfort, according to your comfort zone, according to your income levels and all. Now the mutual fund companies also, they came up with different varieties of plans so that they can reach out to maximum number of customers. So affordability is there, of course, and the last one is liquidity. Yes, for example, if the same amount, if you invest in gold, silver, or buildings, land, and all, it will take some time to convert into money. But when it comes to the stocks, when it comes to the shares, bonds, and all, you can easily convert your share into stock within no time. So that liquidity is highly liquid market, highly volatile market. See, very important for any stock market investor to understand that you will not get overnight returns. Overnight, you will not become a millionaire. So it needs lot of persistence, lot of study, lot of research, lot of risk taking. Okay, because highly volatile market, anything anytime can happen. No one can predict. Even the fund manager also will not give you 100% surety that you will get your 100% return back. Minimum amount you will get your return back. But even the fund manager also cannot assure you. So that is the case. So highly volatile market, highly liquidity aspect as well. So that's what you have to analyze your risk appetite before jumping into any type of any type of purchasing of stocks and shares. So that's why people buy mutual funds. So what are the different types of mutual funds available? Most mutual funds fall into four main categories. That is money market category, bond funds, stock funds, target date funds. Like so, each type has its own features, own unique features, which comes up with this little bit of risk and rewards as well. Okay, so let's get started. What are the different types of mutual funds? First, we'll talk about the money market funds. What do you mean by money market funds? Money market funds are very relatively they are very low risk and they can invest only in certain high quality short term investments. Okay, so which are being issued by the governments. Money market funds are very the risk appetite means the risk is very low in it. Means you will get your certain returns are compulsory you will get. Okay, you are sure that you will get your returns, but the risk is very low. And who will issue that? It is issued by government. It is issued by the local bodies. Okay, this is one type of mutual fund, that is money market mutual fund. Now, second type, bond funds. Bond funds comes up with high risk. They may see whenever we talk about high risk, high returns also will be there. So high risk will be there. At the same time, it will produce high returns. In which areas you will get the high returns in terms of all the different types of bond funds. Okay. So what do you mean by stock funds? Stock funds which invest in the corporate stocks. Not all stocks are same. Okay, in the stocks also we have different varieties of stock. Growth fund stocks, income fund stocks, index fund stocks, sector funds means depending upon the different sectors. So like, so if you are investing in the growth fund stock, it means they may not pay a regular dividend, but you will get above the average returns. Growth fund means what? I have invested 100 rupees. Okay, you will not get 100 rupees, you will not get 50 rupees have your dividend, but you may get a chance of getting more than 50. It can be 120, it can be 200 as well. So above the average you will get. That is called as growth funds. See, very simple logic. In the market, there are different varieties of funds available. Only thing, two factors you should consider. What is your risk? How much risk you can take? That type of fund you should purchase. If I am ready to take high risk, I will go and purchase my bond funds because I want to get be millionaire in just 5 years. Yes, I'll purchase bond funds. I want growth. I'll go with growth funds. I am not interested in regular dividend. I am interested in getting above my financial gains. So definitely I'll go for growth funds. So decide type of risk. Income funds. Income funds means what? Definitely regularly you will get dividends. That is compulsory. You will get if you are purchasing income from any asset management, any mutual fund companies. Definitely you will get certain amount of dividends every year. That is certain. You will not go at loss. The third category, index funds. It tracks a particular market index such as Standard and Poor 500 index as well. So sector funds, if you invest in the sector, investing in sector, you invest in a particular industry. Okay, so those are called as sector funds. So the target date funds holds a mix of, what do you mean by target date funds? Target date funds means which hold a mix of stocks, bonds, other investments. Okay, so it is a mix of both debt and equity here. So whenever you're combining debt and equity, I feel that it will give you optimum results, because debt and equity is always a very plus point for the industry, plus point for the business, plus point for the investor as well. Okay, so that target date funds are quite very very good funds. You should go about with it. So generally, what are the different benefits and risks available in the mutual funds? First case is dividend payments. A fund may earn income from dividends on stock or interest or on bonds. The fund then pays the shareholders nearly all the income less expenses. So dividend payments will be there. Capital gains also will be there. You will get tax benefits also. So don't worry, if you are investing in mutual funds, now one thing is wealth generation will be there. You will get your dividends on time. And capital gain benefits also you will get. Okay, in case if you are waiting for 3 years or 5 years and then selling your stocks and shares, don't worry, you'll get tax exemptions as well. And increase in net assets value also. Higher the net assets value, higher will be your value of investment. So those are the benefits of mutual funds. So what are the different types of mutual fund schemes? Whenever we talk about mutual fund schemes, it are total 8 types are there, based on the organization structure, based on your management of portfolios, based on your growth, income. I told you just now I spoke about liquidity and all. So based on your portfolios, are you going only for equities, or are you going only for debts, or do you want any hybrid investments? So different types of schemes are there. You should choose which you want. What do you want? Overseas funds are also available. Exchange traded funds are available. So there are total 8 types. So you choose what will be best for your financial goals, because each person financial goal will be different. For example, my financial goal might be within 5 years uh, I have to be independent. I have to buy my own house. Okay, independent villa, nice the big car, the luxurious car, living a luxurious life. That could be my financial goal. Your financial goal might be different. So depending upon your choice, your financial goals you have to choose. So those are what is your types of mutual funds. Now, coming to the schemes which are offered by the organization structure. Open-end schemes, closed-end schemes, or interval schemes. Open-end schemes means what, which are very perpetual, where are open for subscriptions. Closed-end means there will be certain maturity date. Interval schemes means allow purchase and redemption, specified transaction period intervals will be there. NAV is nothing but net assets value. Okay. This is your, what is your NAV? I think you people already learned in your financial management as well. Net asset value is nothing but assets minus liabilities divided by your total shares. Where you will get higher the net asset value, higher will be the value of your investments. You can check. What are the costs involved in the mutual funds investments? Whenever you are entering into the mutual fund scheme, obviously no one will give you for free. If I'm going to any company, I'm purchasing any mutual funds, obviously entry fees, so they will definitely take entry load fees. They will definitely charge certain fees, because it is a remuneration for them. So compulsory. So fee will be levied on the investors when they invest in the mutual fund scheme for the first time by the asset management companies for promoting the mutual fund scheme. Okay. So minimum amount compulsory they will charge. In case if you want to leave that mutual fund scheme also, you have to go for the charges. 1% on the redemption value, on whatever the value you get, no, on the lump sum amount, on that 1% charges they will take. So while coming also you have to pay, while going out of the scheme also you have to pay. Transaction charges means any type of buying and selling and all in between if you are doing. So obviously individual once during the investment compulsory will be going through the transactions. So the transactions charges also will be taken by from the customers. Expense ratio. This charge is synonymous with the mutual fund fees and the charges for most of investments. Expense ratio is nothing but it's like an annual fee. Best example, if I'm having a saving account in HDFC Bank, annually they will charge no bank charges. And similarly for the mutual funds also, if you invest in any type of mutual funds in any asset management companies, annually they will take certain percentage of charge from you. That is called as expense ratio. Okay. Expenses like what type of expenses? Sales expenses, marketing expenses, administration expenses, your transactions, your distribution fees, fund managers fees, everything will be collected in that expense ratio from the investors only. Okay. By the asset management companies. So, understanding. Understanding returns from mutual funds. Measuring the performance. While looking at the mutual fund scheme performance, one must not be led by the scheme's return in isolation. Okay, so a scheme may have generated 10% annual return in the last couple of years, but that cannot be constant always. Because see, that is what I said. The fund managers cannot give 100% surety on anything. Past 10 years of performance might be very good. Suddenly something we have already seen during COVID-19, we have seen. So anything can happen. Anytime anything can happen. So we cannot give the surety in that. So a scheme might have generated 10% returns definitely, but that cannot be the same result in the future as well. So like that. So how you'll measure the performance of the mutual funds? By the NAVs, net asset values. If the scheme falls more than its benchmark, it's good. If it is less than that benchmark, then it's gone case. So every stock market, in the stock markets, in the mutual funds also, there will be certain market indices. Market indices means what? Benchmark, the standard marks. So if you get more than that, it's good for you. If you're getting less than that means, then you should think about your strategies. So one must compare your scheme return with the benchmark return. Then only you'll know how much you're getting, how much return you're earning. If you're getting more than your benchmark return, that is actually good. Means your portfolio is working out, your strategy is good. If you're not getting, if you're not able to reach to your benchmark return, then you should the, to think about changing your strategy, portfolio strategy. Okay. Because at least decent returns we expect. More than that also we expect. Okay, if you're not getting your minimum expected returns, then it's waste of time. What are the general key challenges in the mutual fund industry? Building the investor's trust is very, very important. Because in the mutual fund, because now also if you see, we are in 2025. Now people actually slowly they started investing in the stock markets, in the mutual funds and all. Before it was not like that. No. Now also people 90% of the savings they invest in gold, silver, real estate, land buildings and all. Why? Because at least they are sure that they will get some returns from that. Not what some 100% they will get. But that is not a clarity in the mutual funds or in the stock markets. Now also people have that conservative thinking towards the stock markets, towards the mutual funds. If you want to change that mindset, it's very important you have to build that trust also among the people. You have to give the proper facts about the stock markets, about the mutual funds, that here also growth is there. You have to show them the results. Then the people will believe. So while the mutual fund industry also has an immense growth, we have seen from past 20, 30 years, from 20 years, we are seeing that there is a very drastic change happened in the stock markets. Stocks are going up, very good market, very good returns. So you have to build a trust in the people. Indian population always, if they want to invest in mutual 10 to 20 times, they'll think and then they will invest. That is not a case in if you go to US, UK and all the Scandinavian countries or any type of developed countries. There 90% they will invest in stock markets and 10% here and there they'll invest in gold. But in India it's totally reverse. Why? Because our culture is different, our lifestyle is different, our income levels are completely different, our what do you call, our economy is completely different. We have rural areas, we have urban areas, so we are much into the developing stage. So our mindset is completely different. So that is the case. You have to make sure, tell the people about how the investments, how the mutual funds is benefiting them. Go for more number of advertisements, give them proper facts, details, then they will start investing. So overcoming this mindset is very, very, very difficult in the India especially. So that is what, tell them, show them the results. Overcoming the push mentality. Yes, right now mutual funds are more of a push product. Uh, because banks are also directly connected with all the asset management companies, um, with all the financial advisors and all. So people, because of the awareness in the market, people now they are slowly started pushing themselves to gold funds, even online, yeah, e-gold and all, this SIPs, systematic investment plans, trade funds and all. So slowly people started showing that vertical adaptability, because of the awareness. Because if nowadays people are uh, earning very good, they are hiring the chartered accountant from them for themselves. They are also telling them that where are the areas they can invest and they can get better results. And as from the tax point of view also, they are getting attracted. So that is the case. And simplifying the investment process is also very, very important. See, a customer will not have time 24 hours by 7 by time to be in all the looking after the stocks and all. So simplifying, see, if you want to go for the documentation work, it should be very simple, not too much hectic that the customer gets drained and he lost interest. No, it should not be like that. The KYC norms and all, it should be, if the paperwork and all, should happen digitally. Nowadays, everything is digital. So don't go for still manual work, go for the digital work so that the customer's time will be saved. Regulatory challenges are there, yes. Mutual funds in India governed by the regulations, Indian taxation laws, our investment guidelines, SEBI guidelines, especially because the entire stock market is run and governed by the SEBI, Securities Exchange Stock of India. So they will definitely, the SEBI 1992 that takes care the entire stock market in such a way that the people don't lose in the market. The people don't lose interest in the market, so that they bring that proper transparency in the market and investors' confidence as well. The last question: who regulates the mutual funds in India? Obviously, Securities Exchange Board of India, the major regulatory agency for the mutual funds. Because if you see, a lot of scams have happened before SEBI came into picture. Stock market scams have happened. Uh, so because of that only, if the scams coming up in the news, what happens is people will start withdrawing the money from the stock market, which is not good for the health of the Indian economy. People will lose their interest, their trust, which is very hard to gain again. So SEBI has come up with such stringent rules so that the investors, at the same time the companies also, mutually they should get. Structure of mutual funds. Three-tier structure always, okay, where the fund sponsors creates and registers a fund. The fund sponsor is an entity that will set up the mutual fund and registers with the Securities Stock Exchange Board of India in accordance with the Indian Trust Act 1882 as well. Second, the trustee acts like a watchdog on behalf of the investors so that they don't go wrong with the regulations. A business known as asset management companies in charge of the trust management, which will make sure about all the investments are utilized properly and getting the maximum returns and benefiting the overall society at large. That is what is your structure of mutual funds. When did mutual fund actually start in India? Very good question. In 1963, Unit Trust of India, first mutual fund company, was established by RBI to encourage the people to participate in the growth of corporations and to earn benefit as well. Okay. So UTI was a sole mutual fund company in India in the early 1990s when private sector mutual funds were finally permitted to join the market. So from then, since then, we are seeing that change. We are seeing that drastic optimism in the market. Yeah, who is responsible for the mutual funds? Of course, SEBI. SEBI is responsible for creating the policies to regulate the entire mutual fund industry in India to make sure that there is a proper transparency in the transactions. When it comes to the financial statements, there is proper transparency in the financial statements, creating, operating, and managing the performance of the funds very well, making sure the main goal is what? to protect the interest of all the investors. The investors should not feel bad. The investors should always have a happy face. That is the only sole purpose of SEBI. Make sure that they um, make sure that the investors are satisfied with the stock market. So the following is a list of some of the important rules and recommendations that SEBI has released for mutual funds in India. Mutual fund rules came in the year 1996. This particular rule, it states that it talks about establishment, maintenance and administration part of mutual funds in India. This covers issues like regulation of mutual funds, nomination of the trustees, fund management, into how much should be the investment limits and the transparency requirements. The second amendment is 2020, which includes which have concern over the concentration of the portfolios, risk management, and asset allocation. Okay. Uh, the main idea is to increase the portfolio in a diversified manner. Third, categorization and rationalization of the mutual fund schemes has published this circular to rationalize the mutual fund business to end the number of schemes that mutual fund provide with the reduced and clear categorization of the rules so that they can be a maximum benefit for the both company as well as for the investors. Thank you all. Have a nice day.